Number 5, if you are a stock guy, right, you don't buy all those funds or those allocation, right? You have a portfolio of stocks, okay? And you are fully invested. No more cash to buy the DIP or dollar cost average. Fully invested. What can you do? No one builds a perfect portfolio, right? So there's always room for improvement, right? That means your portfolio, there will always be stocks that you realize are not suitable in your portfolio anymore. Maybe when you bought it, yes, but now if you review it, you realize that, yeah, I think this stock, I want to sell. But you are probably not selling because of certain biases, okay, which I'll go through, right? Especially those that you know it was a speculation. You just wanted to buy short term, go up, sell quickly, but it didn't go up, it went down. So you hold, become a bad holder, right? So that is something that you must separate what are long-term investment that can really do well in long-term one, they will prosper one. Given enough time, it will recover, it will become stronger. Okay. Speculations are those usually they won't recover one. Right. So waiting for the price to go back to the price you buy, right, is just wasting time. Agree or not? So you have to be honest with yourself. What is speculation and what is really truly long-term investing? Okay, the more honest you are with yourself, then the clearer you are into what action you're supposed to take. Okay, so speculation, sell if you have better stocks to move to, right? Most of the time, yes, one, you have better stocks to move to one. Okay, so I would say that the speculation ones are the ones that you sell first, right? Then your long-term holdings are the ones that you want to keep, but again, if you have a way to improve it, you have a way to find stronger stocks to replace with, you should still do it. Okay, so these are logic. These are what logic tell us to do, but we don't do this one, correct or not? Why? Because we have all these biases, anchoring bias. Maybe we know we should sell the stock, but after you realize that, but I remember I bought at $10. Okay, that's called anchoring bias because you're anchored to the price you bought. Okay, you're anchored to the price you bought. So you will always take reference to the price. And if the price is at $5, you bought at $10, maybe you put 10,000 inside, then you have lost 5,000. You will not sell because you will keep looking at that loss number very big, right? So you have a loss aversion that's affecting you. Normal, if you don't feel this, something is wrong with you. Okay? If you feel this, it's normal, right? And another thing in psychology is called endowment effect, which means that you will always feel that the stock you have is worth more than what the market is willing to pay for. So that you refuse to sell, right? So if the market price at $5, you say, no way, my stock is not worth $5. It's worth more than $5. So you don't want to sell. So these are the biases that are within us. It's very hard to overcome one. Right? Let's be honest. Okay? It's very hard to overcome. We know sometimes we actually know what to do. Okay, but the emotions tell us otherwise. Right? And it's usually the emotion wins. Okay, it governs our behavior a lot more. So some things that can help you, right? Help you again change your perspective. Right? The only way I can do is to help you change your mindset. Okay, I cannot instruct you what to do. I cannot order you what to do, right? So some of these perspective changing things that you can do may help you. Okay, so you can try it yourself. Ask yourself this, let's say all the stocks you have is all liquidated, all sold. So you have capital, right? You take back your capital, right? Ask yourself, will you buy the same stocks again? Okay, ask yourself, will you buy exactly the same stocks again at the exact proportion and allocation? Most of the time, the answer is no one. Okay, some stocks you'll buy back, but some stocks you say, well, I'm good to get rid of it. Thank God I got rid of it. Okay, so you can think of it this way. Because when you have the stock, your endowment effect is very strong. You will always feel your stock is worth more than what the market is willing to give. Okay, so you imagine you take away this endowment effect. Imagine you don't own the stocks that you used to own, and now with the capital, will you buy the same stocks again? Okay, I can guarantee you the answer is no one. Okay, then you know you're actually suffering from endowment effect. All right, you're actually trapped in your own bias. Yeah, so this is the first perspective you can test with yourself. Okay. Second way to think about this is that understand money is fungible. You don't need to make back the money the same way you lost it. Okay. For example, you lost money in stock A, and actually you know stock A hopeless already, but you just refuse to sell because selling means realizing the loss. Right? And it's painful. like what the biases we said so far. Okay, loss aversion, it's painful. So it prevents you from selling it. But sometimes, you think about it. If you lose 5,000 from stock A, right, you don't need to die make money, make the same 5,000 back from stock A, right? Because this $5,000 is fungible. Whether you make it from stock A or stock B or stock C or D or E or F, right, it's the same $5,000. Who cares whether you make it back from stock A or not? In fact, if you think stock A is hopeless and stock B got a better chance to rebound, then the logical way is to shift your money to stock B. Agree? Right? So sometimes you think about it, then you realize that how biased we are in our decision making. Okay, the endowment effect, loss aversion, anchoring biases, all these are very strong, even we don't even know it. Right? But all these perspective changing questions may help you. Okay, so if you don't have capital to deploy, it's not true. You can optimize your portfolio one. Okay, just whether you want to overcome that bias. All right. So sell the weak, buy the strong. Easy to say, but hard to do. But I give you some tips how to overcome them. All right. And to sum it up, I still got more tips, but just for a quick tactical positioning. When I say tactical, means it is like a satellite portfolio, not your core, or it can be something short term. Short term means a few months rather than a few years, right? Because some people will say, oh, if let's say given the current market condition, what should I invest in? What should I sell? What should I do, right? These are very tactical thinking. Okay, because what is strategic, right? It's like, what is your game plan? Are you doing a dollar cost averaging strategy? Are you doing an asset allocation strategy? Are you doing a particular like growth investing strategy, value investing strategy? These are more strategic questions. Okay, tactical positioning is like people asking for stock tip. Tactical positioning is like, what should I buy now given that the market is like that? Right? So it's very reactive. It's very short term in nature. Okay, but I know some of you are interested. That's why I share this. But I want to warn you. Okay, I don't actually do this kind of tactical positioning. I focus more on the strategic part, because if you get a big picture right, then you will know tactically what to do, right? And not just focus on tactics, but there's no strategy involved. You're just rojak portfolio here and there, which I don't think that's the way. But I know some of you want to know. So let me tell you some of the effects, okay? Given certain scenarios. If the inflation has peaked and interest rate risk is gone, which I'm alluding to, right? Then it's good news for long-term bonds. Why? Because long-term bonds are very sensitive to interest rate. If interest rate go down, your long-term bond price will go up. So for example, the recent Singapore 50-year bond, some people hear, what, 50-year? Crazy. I don't have so much life to live anymore to receive the maturity. But it can be a speculative play, because the 50-year bond will move up more than the 30-year bond. The 30-year bond will move up more than the 10-year bond. So the longer the tenure of the bond, the more volatile the bond is going to be. So if the interest rate goes down, these ultra long-term bond prices will shoot up, almost like stocks. Okay, their volatility is almost like stocks, 30-year and above, right? So that is one way. Okay, if you believe that inflation peak, interest rate is not going to go up that much, long-term bonds rallies, right? And interest rate risk, physical property, I believe will do well as well. Especially Singapore market, the properties are still very hot, okay? And one of the key concerns was that, wow, imagine your mortgage loan is 5%, wow, jialat, right? How to service the loan? Okay, so if interest rate is going to maintain maybe 2-3% mortgage rate, something is still is at a level that is still reasonable and affordable, right? So that can also be it will fuel the property prices further, right? Then third one is Reits. Okay, same thing. Why Reits? Because they borrow money, right? So if interest rate risk is no longer that high, your Reits prices will rebound. Okay, this is isolating. That means there are no other bad news affecting these asset classes. Okay, that's assumption, right? So if only just the interest rate risk, one is gone, your REITs will perform, because this year the REITs came down likely also because of the interest rate environment. Okay. High growth stock, not just growth stocks, high growth, like your 30% growth rate, 50% growth rate revenue, that kind of growth stocks. Okay, those higher risk ones, smaller cap. These high growth stocks, right? Why would they go up when interest rate come down? Is because a lot of their value is in the future. Okay, it's about future value. Then interest rate, right, is the discounting mechanism. If the interest rate is high, they will discount more value to present day value. But when the interest rate risk is lower, that means the discounting of future value will be lower. And that's why the growth stock today will be worth more. And that's the upward buying pressure, right? Crypto, because of that general risk-taking behavior. Okay, so there's more money sloshing around, people are more risk on, because high growth stocks and crypto move together, if you notice. Okay, some people say crypto is like gold. No, based on the past price behavior, they are closer to high growth stocks. So if crypto do well, high growth stock do well, vice versa. Okay, so they tend to be together, right? The relationship in that sense. Maybe the people who buy high growth stock are also the ones who buy growth crypto lah. That's why they behave together. Okay, that could be a reason. All right. And then if the interest rate risk is low, which also means that inflation has peaked, okay, then your commodities are likely to do well. Right. So these are tactical positioning. Okay. So these are not strategies. Right? This will not last you a long time. This will only last you maybe after the scenario play out. Okay. How do we know interest rate is fading away and starts to see the asset classes to rise? Remember, I said that follow the market. Right? Look at the markets. In fact, a lot of all these have already gone up. Long-term bonds have went up. Physical property is still hot. REITs have recovered a bit. High growth stock has went up a lot. Crypto has went up a lot, especially Ethereum. Right? So it has already happened. Okay. And then CPI have come down. So it's basically what I mentioned just now. Right? If you miss the beginning, you can rewatch the recording. Okay, then you get a picture of what I'm trying to say. Right? Then if let's say inflation has not peaked, interest rate risk is still there, Federal Reserve is going to raise interest rate, okay, then reverse whatever above lah. Okay, it's exactly what you have experienced in the last 9 months. Okay, those assets like this didn't do well, except physical property in Singapore. Physical property in US actually came down, the prices, right? Not hot anymore already. Okay, so then the next thing is that what if recession risk comes in? Then I would say that the best bet would be defensive sector, right? Such as consumer staples. That means like your grocery stock, like your Sheng Siong, all this kind. Big tech company, because I would believe that they are more defensive than a lot of other companies. It's not like during recession you will stop using Gmail, you will stop watching YouTube video, you will stop checking your Facebook, you'll stop checking your Instagram, you'll stop using WhatsApp, you'll stop using your office, right? So it is very likely that this big tech will be resilient even during a recession. Just that their earnings, their revenue will not do as well during the boom times, but they will likely still grow on, right? So these are the example of defensive sectors. Utilities, okay, because you still need it. And another one will be healthcare, healthcare services, okay? Because recession doesn't mean you don't need to see doctor, right? If you need to see, means you need to see. Okay, so these are example of these defensive sectors. So understand, these are tactical positioning. I'm not saying that you should do this. In fact, I would discourage discourage you to do this, because these are very short-term positioning, and your positioning can also be wrong. Precisely why are we sharing so many different scenarios? Because this can happen, this can happen, this can happen, and this can also happen. The bull is back, right? The bad news are all contained. Okay. So we really don't know how you unfold. So if you just position because of a particular scenario you believe it will be, and then it didn't turn out, right, your chances of losing money becomes very high. So that's why I discourage people from doing this. But I know this is what a lot of people like. Right? So I suggest that approach for a more strategic way. Okay, that means have proper strategy, how you approach the market, then be consistent with it, rather than doing this kind of very little maneuvers here and there, right? Because the chances of it getting right is not very high. Okay, let me be honest with you, because even your PhD economists cannot get it right? A bit difficult one, right? To get the economic outlook correct, tough. Okay. Fed is likely to raise rates by 50 or 75 basis points in September. Yes, it is. Right? But you know, if they raise 50 basis points, the market happy already, because then they agree that the Fed is going to taper. They taper the hikes. By tapering hikes, already a win already. That means inflation is controlled already. Okay. So again, if you miss the front part, which I explain all this, that's why I say it's very important to explain the front part. Otherwise, all this don't make sense, right? So if you miss the front part, refer to recording, you will get a picture what I'm trying to say. Okay. Of course, I'm more inclined on the first scenario. That's why I put it at the top. Right? More likely the first one.